In our prior video, we talked about some of the income which taxpayers must recognize on their tax returns. In this particular video, we're going to talk about some of the deductions which taxpayers are allowed to take in order to reduce their taxable income, which ultimately will allow them to reduce the amount of tax which they will owe on their tax return. Now, there are two types of deductions that are allowed for tax purposes. One is called the itemized deduction, and the other is called the standard deduction, and we're going to discuss both of those in this particular session. Now, with itemized deductions, as the word states, itemized, it's really a listing of different types of deductions that are allowed. We will, after covering all of our itemized deductions, we're going to talk about the standard deduction, which is one amount that is allowed in place of itemized deductions. And we'll talk a little bit more towards the end of this lecture as to what that means. So again, what are deductions? Deductions are amounts for expenses or costs that taxpayers have paid out of pocket. They could have paid it in cash, they could have paid it by check, they could have paid it by a credit card. Whatever the method may be, they are allowed to take a deduction or reduce their taxable income by the amount that they paid for a particular cost within the allotted items that we will discuss that are deductible. So when should someone itemize a deduction? Remember, an itemization, it really means just to list out. So there's a list of particular types of costs or deductions that people are allowed, and when should they take them? That really is the question. The question is, you take your itemized deductions when those itemized deductions are higher than what is called the standard deduction. And the standard deduction is a set amount that is put in place every single year, and that amount may be taken in place of itemizing in most cases. Now, there are cases where taxpayers are required to list or itemize their deductions rather than take the standard deduction, and we will talk a little bit about those particular scenarios when that must happen shortly. Now, itemized deductions are actually taken on what is called a Schedule A form. And on that Schedule A, we're going to see that the very first section listed is a deduction for medical and dental expenses. So if you have any medical and dental expenses that are allowable under the code, and one of the major exclusions here that taxpayers must be aware of is that cosmetic surgery is not considered to be an allowable medical deduction. Why is that? Because it is a surgery that a taxpayer may opt for. It is not something that is necessary. So in that particular case, that would not be deductible. But other expenses, such as going to see your doctor, having your blood work done, having particular tests done, like an MRI or a CT scan, and all of these different languages that doctors talk about, different expenses, those costs are deductible. Going to the dentist and paying for dental work, that is also deductible. And other items that are deductible are things like purchasing dentures, getting eyeglasses if you need them for corrective vision, and those type of things. And also prescriptions for medications, but not over-the-counter drugs. Now, medical and dental expenses are allowed as a deduction only to the extent that they exceed a taxpayer's AGI, which stands for Adjusted Gross Income. And we will talk about that in a later series. But for now, just understand that medical and dental expenses are potentially deductible for the taxpayer as long as they meet the AGI requirements. When we talk about the next category of allowable deductions on our Schedule A or itemized deductions, as they are called, state and local income taxes fall into that category. State and local income taxes in particular states where there may not be income tax is obviously not going to be beneficial for some taxpayers who live in Florida or live in Texas or live in New Hampshire, because there is no income tax in those particular states. So in place of sales and state and local income taxes, those particular taxpayers may take a sales tax deduction for any sales taxes that they paid on purchases they made within the state. Real estate taxes are also allowed under this. So if you purchased a home and you're a homeowner and you're going to pay real estate taxes every year, then on those particular real estate taxes, you are allowed to deduct them on your Schedule A as an itemized deduction. And there are other types of taxes which are also allowed as a deduction, such as the foreign income tax. If you have paid some taxes on any foreign income that you have earned, would be deductible in this category. And also excise taxes. And excise taxes on, let's say, a vehicle is a fee that you pay, most likely to a city, some type of locality, for the ability, or I should say the privilege of being able to drive your vehicle on those roads. And they will charge you an excise tax for that, usually on an annual basis. So all of these taxes are allowed as deductions, but based on our new tax, which started in 2018, we have some significant changes which now cap the amount that you can take in this category to $10,000. In prior years, the amount was not capped, but starting in 2018, taxpayers are only allowed to deduct a maximum of $10,000. So that is something that we may have to discuss as we meet with our clients in the tax center. On our next category on our Schedule A, where we list our itemized deductions, we're going to see the interest paid category. And taxpayers are allowed to deduct certain types of interest, such as interest they pay on any mortgage that they hold. And a mortgage is a loan that you receive from a bank or a mortgage company to purchase a home. And when you purchase that home, they're going to charge you whatever the particular interest rate may be, and you will pay interest on that mortgage for the purchase of that home. Now, you are allowed to take a deduction for that mortgage interest. You're also allowed to take a deduction for points that you paid as a form of interest, and points are paid at the point of purchase of a home in order to reduce the interest rate. You may pay some additional cash in that transaction in order to reduce your interest rate, which of course over the lifetime of the loan will help to reduce the amount of interest or finance that you are paying on that particular loan. We are also allowed a deduction for any investment interest, and investment interest is a little bit out of scope for what we're going to be working with in the tax center, but just so that you're aware, investment interest would be paid on a margin that you may hold on an investment account, and in that particular case, you would be allowed to deduct the interest to the extent that you generated income from those investments. Moving on, taxpayers are also allowed to deduct gifts for contributions that they have made to charity. Now, a charity must be an exempt organization, which actually is listed with the IRS. So we're looking for a type of organization which has received exempt status from the Internal Revenue Service. It is a nonprofit organization, and if they meet those qualifications and you make a charitable contribution or a donation, you will be allowed to deduct the amount that you made in that contribution. Now, taxpayers may be providing gifts to charity which are non-cash, but in most cases we will be dealing with cash transactions. But just so that you are aware, taxpayers often make donations of clothing and small appliances and furniture and a lot of different things, including stock, to organizations. And how we treat that transaction depends on what type of donation is being made. Now, in this particular case, we're going to talk about cash because that is most likely what we will be seeing at our center. If the taxpayer makes a cash contribution, there is a limitation. The limitation would be 50% of the AGI, which again is adjusted gross income. And we're going to talk about adjusted gross income in a later series. But just keep in mind that if a taxpayer makes a gift to a charity, an organization that is recognized by the IRS as a nonprofit, they are allowed to take a deduction on their tax return if they itemize their deductions. The final section that is noted on the Schedule A, where we list our itemized deductions, will be miscellaneous deductions. And that's just a kind of a category that's more of a catch-all for things that did not fall within the categories that we have already discussed. In this particular case, you will find gambling losses. So gambling losses, if you go to the casino and you're playing big and you thought, hey, I was going to be a winner, but you fell short, well, you may be able to deduct some of those losses, which helps hopefully take a little bit of the hurt out of the transaction. But I will say this, you only can deduct those gambling losses to the extent that you actually generated gambling winnings. So if your losses exceed the amount of your winnings, you may not deduct any excess. But when you are gambling, if you have won, you must recognize that as miscellaneous income. And we're going to talk about miscellaneous income in another series. But because you must recognize the income, the IRS is allowing you to take a deduction against the amount of income that you must recognize. But your deduction cannot exceed the amount of income that you made. So if you won $3,000, you have to report $3,000 worth of income. And if you spent $5,000 to try to win that, $3,000, you may only deduct the $3,000 on your Schedule A. You may not deduct the additional $2,000. That just becomes a personal loss, which you will never recuperate unless you go back next weekend and you hit big and you win. We'll see. I wish you luck if you're in that scenario. But an additional deduction that is allowed in this category would be work-related expenses. But these work-related expenses, it's only for disabled individuals. Okay, they must meet the federal required definition of a disabled individual, and this is not allowed for anyone else. It used to be prior to 2018. If you were searching for a job and you had some expenses, or if you had a job and you were paying some out-of-pocket expenses that was not reimbursed by your employer, that you could take a deduction in this category, but that is no longer allowed as of 2018. So now, we went through the list of itemized deductions that are allowed, and I mentioned at the beginning of the video that we had two different options, and the first option was to itemize as deductions as we discussed, but the second option was to take the standard deduction, which is a set amount that is allowed a taxpayer every year. Now, in 2018, the amount in the standard deduction that's allowed for an individual taxpayer is $12,000. If you are married filing jointly, you are allowed a standard deduction of $24,000. And if you are head of household, you are allowed a deduction of $18,000. A qualifying widower would be allowed the deduction of $24,000. Now, when we're looking at itemized deductions and we're looking at the standard deduction, well, how do we know which one to pick? The answer to that is very simple. We're going to add up all of the amount of itemized deductions that are allowed for the taxpayer, and then we're going to compare that to the standard deduction. Now, let's say, for example, the taxpayer is a single individual, and let's say we added up all of his itemized deductions, medical, taxes, miscellaneous, whatever that may be, interest, and that only came out to be $8,000 in total. Well, we know that the standard deduction for the individual is $12,000. So in that particular case, we are going to opt for the standard deduction because it is higher. And because it is higher, it's going to reduce the taxpayer's taxable income to a lower amount, and in our case, by the difference of $4,000, which means that the taxpayer is going to pay a lower tax on that amount of the excess deduction they are getting because they've selected the standard deduction. Now, it's important to note that there are some situations where a taxpayer is not allowed to take the standard deduction, and in that case, they must itemize their deductions. Even if the itemized deductions turn out to be less than the standard deduction, those particular taxpayers must itemize, which means they would get the reduced deduction amount. One of those cases is if the individual is married filing separately, and if one of the spouses is itemizing, then both spouses must itemize. One spouse cannot itemize and the other take the standard deduction. So spouses need to be sure that they understand how the other spouse is filing so that they can file in the right way. Additionally, if you are a non-resident or a dual status alien who is not married to a U.S. citizen at the end of the year, you also may not take the standard deduction and must itemize. The standard deduction is higher for individuals that may qualify for an increased standard deduction amount because they meet one of two criteria. One could be age, and age would be an individual who is 65 or older. Second would be if they are blind. So if an individual is over the age of 65, or if the individual meets the federal definition of being blind, they are allowed an additional or increased standard deduction, as you see listed here on this particular chart, which could be either $1,300 or $1,600. Finally, as I've noted a couple of times throughout this video lecture, when we're looking at itemized deductions or standard deduction, recall that we're going to take the higher of unless the individual is required to itemize. And how we're getting to taxable income, I've noted this a couple of times throughout our series. We're taking the income that the taxpayer must recognize, less the amount of deduction they're allowed, and that should be the higher of the itemized deductions we discussed in this series, or the standard deduction unless the taxpayer must itemize. What is left after we take the difference is the amount of income that is taxable, and we refer to that as taxable income. We then take that amount of taxable income, we use our tax rate schedules dependent on the taxpayer's filing status, and we determine the actual amount of tax that is due on that income.